comprehensive income. So gross margin is on the regular income statement, therefore it's in comprehensive income. Operating income is on the regular income statement, therefore it's in comprehensive income. So the answer here should be yes, yes. So number 14, answer should be D. Answer should be D. 15, understatements of financial accounting concepts, comprehensive income, same thing. Whoops, don't have it lined up for you, excuse me. Understatements of financial accounting concepts, comprehensive income includes anything on the income statement. So gains would be on the income statement, gross margin would be on the income statement. So we got a yes, yes there. So you see how to write that question. You see how to write it. It's not technically in comprehensive income, but anything that's on the income statement, since comprehensive income starts with net income, they assume is part of comprehensive income. A couple of basic questions here most of you will get. Number 16, the principle of objectivity includes the concept of verifiability. Unbiased, objective, verifiable. So number 16, answer should be D. 16, answer is D. Everybody's going to get number 17. 17. Which of the underlying concepts, which is the underlying concept that supports the immediate recognition of a contingent loss? Conservatism, right? Yeah, we all got that one. Good. 19, again, I think reading these help. Periodic net earnings are conventionally measured by transactions approach using recognition of unrealized gains and losses, capital maintenance approach, market value approach. It's not complicated, it's just simple transactions. We record journal entries, those are transactions. We then sum those up and come up with periodic net earnings or periodic net income. Good. Number 20. Talked about this in chapter 10. Under what condition is it proper to recognize revenues prior to the sale of the merchandise? Prior to the sale of the merchandise. When the ultimate sale of the goods is at an assured sales price. That's probably as good as you're going to get. The revenues reported on installments, no. When the concept of internal, that doesn't make any sense, does it? When management has a long-established policy, no. Best answer you're going to have there is when the ultimate sale of the goods is at an assured sales price. If you remember in chapter 10, we said there's really two criteria, arm's length transaction, and then this one, ultimate sale of the goods is at an assured sales price. You have a contract. Remember I used the example of selling wheat. You sold your wheat, you put it in a silo, you're going to deliver your wheat after the first of the year. Well, as long as you got a contract at a set price, we'll buy all the wheat you got for X number of dollars per bushel, you can go ahead and recognize the revenue. So that in essence is the same question there. Okay, one more. This one is just a silly question. Silly question. But it's technically correct if you read the conceptual framework. According to the FASB's conceptual framework, asset valuation accounts are. Now see what they're saying is we're talking about the allowance for uncollectible accounts. We're talking about accumulated depreciation. We used to call those contra accounts. In the textbooks in the class, we call those contra accounts. So we're saying, what do you do with these contra accounts? Using the conceptual framework. So according to the conceptual framework, valuation accounts are neither assets nor liabilities. Like, give me a break. Okay, they got real technical. This is just some egghead writing this thing. So they got very technical and said, they're really not accounts, really not part of accounts by themselves. They're part of the actual account. So the valuation account for uncollectible accounts is a part of accounts receivable. And accumulated depreciation is a part of property, plant, and equipment. All right? So that's what they're saying. They're part of the account. Therefore, by themselves, they're neither assets nor liabilities. Okay, I think it's a very strange problem. That's the reason I want to show it to you. Okay, the last thing we're going to do in Chapter 7 is fair value. Everything we read, everything we hear about today, fair value, fair value, fair value. Europeans have used fair value for years. As we go through this worldwide accounting situation, we're going to go more and more to fair value. So if you look on page 715, 7-15, let me just take you through where we are so far with fair value. And I'm sure something is going to be added next year and something the year after it till we eventually get to full fair value. So if you're over to page 7-15, this is FAS 107. Now this one's been around for a while. It requires you to disclose the fair value of financial instruments. Now focus on everything that we're going to do tonight deals with financial instruments. We're not talking about property, plant, and equipment. We're a long ways from there. We're talking about financial instruments. So right now, you have to, and you've had to do this since, was that 107, probably 7 or 8 years, you had to put into a disclosure supplemental information about financial instruments. For example, you've got accounts receivable, notes receivable, accounts payable, notes payable, loans receivable, any kind of